Chuck. An article in the Wall Street Journal today on Warren Buffett's portfolio, now within reach, by Brett Ahrens, gave me an opportunity to actually utilize these Graham-Dodd adjusted charts that I talked about in Monday and Tuesday's blog, and look at a company that Warren Buffett recently purchased, Johnson & Johnson. I'm using the Graham-Dodd adjusted formula. Now, as you can see, Johnson & Johnson has been about a 12.7% grower historically. The light blue turquoise area, I guess you might call it, area here shows the dividends. Those dividends are paid out of the company's earnings. So you can see by this picture it has a nice dividend record, and it's increased it every year. I also want to point out that it's been a very consistent earnings grower at about that 12.7%. That's, the 8.5 to 15 area that we talked about in Monday's post. And, so what you're seeing here is a company that historically has traded at around 19 times earnings or higher. And, then the article Mr. Ahrens talked about when, Warren Buffett bought it. Well, as you can see, over the last couple of years, the price-earnings ratio has fallen. In other words, Johnson & Johnson is trading below its, Graham-Dodd EDMP adjusted growth rate. And where Warren purchased the stock was somewhere around 62, it said. So, here's 60 in 07, here's 64 in 08, here's, the $62 range that Warren Buffett would have been paying, $61 in October of 08. So my point is, Warren Buffett was buying Johnson & Johnson, I'm sure, or when he was buying Johnson & Johnson, I'm sure he thought the company was very, very reasonably priced. It had a decent dividend yield, I'm going to guess, over 2.5% at the time, and he was making a long-term position. Now, subsequent to that, obviously the price has dropped, and it fell, all the way down to in the 40s, and it's now currently trading at around $55 a share. And what Mr. Ahrens pointed out is that, Warren Buffett actually purchased more. And to me, that's really what a long-term investor does, because looking at this picture, at least from a historical perspective, Warren Buffett, I think, as I said in the post, felt very strongly that this company was very reasonably priced. When you look at its long-term record, even at its low valuation, this is one of the lowest price-earnings ratios that Johnson & Johnson has ever traded at. It's, just over 12 times earnings. I want you to also notice that the price to sales for Johnson & Johnson is at the low end of its range, one of the lowest current price to sales it's ever traded at. And then when you look at its long-term track record, $100,000 in Johnson & Johnson on January 31st, 1990, would have grown all the way to $839,837.67. That's an 11.6% long-term rate of return, which, by the way, is very consistent with its earnings growth rate, considering that the stock is currently, somewhat undervalued. But also then look at the dividend record. And what's really attractive today is when you're looking at Johnson & Johnson, you've got this 3.3% dividend yield that, Mr. Buffett was, picking up, and he's a patient, long-term investor. He sees a bargain here. He's finding a good yield. When last time, if you'd bought it in 1990 when it was yielding 3.4%, you can see that they continuously raised their dividend year after year after year, and that yield increased rather dramatically. When you add dividends into the equation, and this performance that the fundamental research tool always produces always assumes that dividends are being spent. But, over the last 20 years, it's thrown off over $230,000 on a $100,000 investment in dividends alone. The yield is increasing very dramatically. You have a very attractive company, one of the highest quality companies on the planet, trading at a significant discount to its normal valuation. And Mr. Buffett originally bought it when it was cheap. But, he's not worried about finding perfect tops or bottoms. He's working about making good, solid, long-term investments. And I believe Johnson & Johnson is clearly that. I think he felt that way when he bought it in the mid-60s. I think he feels that way certainly today at 55. He actually sees this as an opportunity, not a problem, because he's not reacting to short-term stock price movements. He's making long-term investment decisions in companies that he feels very comfortable with, that have good fundamentals, a good long-term record, and that he intends to own for many years to come. I hope this gave you some perspective on what we've been talking about all week. This is Chuck Carnevale saying thanks for listening, and talk to you again tomorrow.